Hello, hello. I am the Unemployed Value Degen, and I'm here with my former student Mitch. And nothing that we say is financial advice. And the purpose of today's video is we're going to go over some of the different macro themes and try and figure out how to position ourselves for 2025. In front of me, I have the dominant theme in the marketplace right now, I think, is artificial intelligence. So I have a chart of the NASDAQ. Mitch, why don't you go ahead and say hello to everybody?
Hey everyone. Thanks for having me on, Coach.
Oh, it's always a pleasure. Thank you for coming. One of the big concerns right now is that the NASDAQ has not broken back above its July high. And it hit some resistance, it collapsed. And then just in the last 2 days, it had a bit of a crash. But I don't know if that's uncertainty surrounding this upcoming election, or if it's uncertainty surrounding, Iran and Israel keep threatening to retaliate over the weekend. But whatever the reason is, the Nasdaq is below the July high, but the S&P 500 isn't. The S&P 500 is able to grind above that July high. So one question is just, what do we think the future has for 2025 as far as the artificial intelligence data center build out narrative? This is NVIDIA. Now, NVIDIA did break below the July high. Let's see. Or break above it, sorry. But it's now come back down below. So what do you think of those charts, Mitch? NVIDIA, the triple Qs, and the S&P 500. What do you think the technicals say about what does 2025 hold for these things?
Yeah, so I think a large focus for investors is going to be this election, right? There's been this huge run up going into it, and I think, either way, the market is looking like it is looking to at least, temporarily take a step back, right? But
Yeah.
as you've mentioned, especially with the SPY, X technology, it looks like the market, is setting up to potentially rebound higher after a pullback. So the fact that it's sitting here at its 50-day moving average, that's exactly where it bounced to. And it's the same deal with the QQQ. I think that there's going to be a whole lot of uncertainty this week with the pending election, and I've been thinking for a while that it was going to be a sell the news sort of deal with the election. The market's kind of pricing in either way to go down after the election, just more so different sectors. But I think more important than that is we still have 99% implied probability of rate cut in November, and
Yeah.
I think 82 to 85% for both November and December. And I think that will end up playing a bigger hand than anything, right? If the market does decide to pull back this week during the election, I think it could be setting up a huge buying opportunity for pretty much the overall market. The economy is really not in terrible shape right now. I think it's going to be set up to at least in the near term keep rallying.
Yeah. Well,
um I, yeah, continue.
there's a lot going on. So we had our first rate cut. It was 50 basis points. And on the news of the first rate cut, the 10-year Treasury rose instead of falling. Now, some people are taking that as a sign that the market's pricing in a policy mistake. And some people are taking it as a sign of, because the only other time that happened was 1995. And they're taking it as a sign as recession risk is off the table. Because if there's no recession, you don't need the flight to safety, you don't need to go into bonds. So people are unclenching their recession insurance, which is totally feasible. But the 10-year going up is not what people are expecting, because even if the benchmark overnight rate is cut, if the 10-year is rising, that could put a drag on the stock market. But if the overnight rate affects things like margin loans, but the 10-year affects corporate borrowing. So this is a bizarre world where the overnight rate was cut and the 10-year is rising. Just on the well, it's hard to see. I don't have a 3-year choice here, but I've seen some people doing the technical analysis in the 10-year and drawing some crayons and make it seem like maybe this point here is hitting resistance in this downward trend. I don't know if there's enough to this chart that you could give an opinion on that.
Yeah, I mean, it definitely does have those, lower highs and lows look to it since 2023, that July high. So, I mean, it's possible, but like you said, this is some real odd behavior for the underlying rate to have been cut, and for the 10-year to be moving in the opposite direction. That honestly makes me worried more so than anything.
Yeah.
Right? I yeah.
Well, it's
Lower
definitely
rates are going to be
unusual
needed
behavior.
yeah, and lower rates are going to be, lower treasury rates. That's going to be needed for things like, the real estate market to really unlock,
Yeah.
right? And I think that's a pretty critical part of the economic rebound. So that it's definitely something to watch. And rate cuts in general, see if they continue to impact it this way. I think that'll be a big telltale sign. If rates cut again and the 10-year still goes up, that might be some bad news.
Yeah. So I've definitely heard some opinions out there that 4.5% would affect the stock market, 5% would affect the stock market. I don't know. I have seen some other people say, though, that this is making a pattern that maybe this is going to be a temporary peak and it'll start falling from here. Maybe things will unclench for a bit. But, I mean, if the 10-year Treasury just kept rallying up and, say, kept climbing past 4.5, 4.75, even close to 5, I think there would be some, a bit of panic out there. That would, but it does affect the 30-year mortgage, but that's been putting a big drag on existing home sales. The home builders have been buying down mortgages, and you can get a mortgage with a 5 handle if you buy a new home. And I think the home builders themselves, they've been struggling. So I think the home builders have pulled back. Is there a home builder ETF?
Yeah, I think maybe NAIL might be a Direxion home builder fund.
Yeah, home builders and home supplies.
That might be. That's 3 times leverage, though.
You're showing your
always.
XHB. There we go. XHB for those who are not degenerate gamblers like Mitch. Okay, it's the same chart though.
Same chart.
Yeah. So there has been a bit of a pullback for home builders, but it's still been on a huge tear this whole year. But yeah, business is good. They take the hit on buying down that mortgage, and in existing home sales, a home buyer could. I mean, a home buyer could spend $10,000 or $20,000 buying points, but it's just too painful when you pay closing costs and you pay the down payment. Just the home buyers do not want to do that, so they sign up for a 7% mortgage, and the home builders say, hey, as a closing bonus, we'll buy down your mortgage, and you'll have a mortgage at 5.3% or something like that. So even if mortgage rates stayed high, the existing housing market might be frozen, but the new housing market might not be. But yeah, then there's also the effect on corporate borrowing. Yeah, that's one of the main themes is what the heck is going on with interest rates. And I personally am in the camp that we're in this 40-year super cycle. Let's see, what was the Fed funds rate? So now not everybody has this thesis, but to me it looks like, and you can also take this data back, some other economists have done this and gone back into the 1800s, but it looks like we go through 40-year phases of 40 years of rising interest rates, 40 years of falling interest rates, and maybe we've bottomed out and we're going to be on a path toward rising interest rates, but rising interest rates with ups and downs. But another aspect of that is everybody said, well, are we going to get to 14% interest rates, 15% interest rates? One of the aspects of the 70s, it wasn't just inflation. It wasn't just, guns and butter for the Vietnam War and Johnson's Great Society. It was also the oil shock. So we might be in a period of rising interest rates, but I think without the oil shock, I don't think things will get as bad as the 70s. So I definitely have a sustained inflation hypothesis, but it's not as bad as the 70s because now we have the shale revolution, so there's no oil shock coming. Um, what's
Right.
your
And to build on your point, about inflation, I mean, this week's inflation read was hot, which points towards, higher rates for longer.
yeah
So I think there's definitely some feasibility to that. And yeah, I mean, inflation, that was a large criticism of the 50 basis points rate cut. Was it, too much too soon? And that's what the, inflation results
yeah
are reflecting, So I wouldn't be surprised if sustained inflation is a continuing issue, and that the rising rates don't necessarily mitigate it the way that they're intended to.
yeah, and then the rates aren't really rising if they're being cut because now we're in a cutting cycle and we're in a China stimulus cycle, and that could bring the prices through to commodities, then it gets through the supply chain, and then anyway, inflation might have bottomed out in September, so we'll find out. I brought up the Trueflation Index because people are criticizing the Federal Reserve's core and super core and PC and all that stuff, and one of the aspects of the CPI is they smooth out the effect of housing, and I suspect the reason they did that is because they don't want to scare everybody. If they hadn't smoothed out the effects of housing, instead of having a peak of 9% inflation, we'd have had a peak of like 15% inflation. But the
Yeah, it's all
consequence of that
data
is,
manipulation, and I don't think that this CPI is really a great measure
yeah.
because of that exact reason.
Well, but the consequence of that smoothing out, though, is that the Fed is going to be looking at. So even when trueflation was at 1%, the CPI was at 2 or 3%. So that the prices are going to be pushed through in the CPI, but it's just going to be this slow lagged effect higher. So even when your cost of groceries is only going up 1% a year, then Jerome Powell is looking at a number going up 3% a year just to pay the penalty for when it was 15%. They told us it was 9. But I strongly suspect we're going to look at an average of somewhere around 4% price increases for the next several years, but with ups and downs. And this to me looks like we're back on the ups, right? If we're coming in
Yeah,
with 2.63% on trueflation, and then you add the lagged housing effects onto that, um, you know, but the Fed is on a cutting path, and the other central banks. So globally, all the central banks are on a cutting path, and China's on a stimulating path. So we might really be, there's a lot of people saying whoever inherits the economy after this election is going to face a crash. I think it's possible that they're going to have just a rip your face off economic boom, that we're going to have, we're the end of destocking for logistics. You're going to have rising prices. You're going to have China stimulating. You're going to have interest rates falling. And just we might be on the verge of a pretty massive economic boom.
yeah,
But
I completely agree with you there. And back on my point, I think that if the stock market continues a downturn here, it's going to be a generational buying opportunity, similar to the way COVID was.
yeah,
Exactly because of what you were saying with inflation. It's going to trickle down all prices of commodities, and everything is going to be going up. So
yeah. So
I think that could definitely have assets follow inflation. Simple as that.
yeah, this could be if there is a dip, and there's no guarantee we'll get one, but people are afraid of one. But if there is a dip, this is probably a good dip to buy.
Yeah, I agree. And like on this chart, if we're gonna see this sustained rally, I think it'll post a higher low than the September bottom. So I would expect maybe something closer, you know, yeah, around there.
Something, well, it doesn't quite make a straight line, but something. I mean, we might already be close to it, but
Yeah, I would expect a lot of volatility this week for sure.
yeah.
I mean, there's just a whole lot of uncertainty in the market, and uncertainty equals volatility.
Well, so my dominant theme is sustained inflation. Also, I'm a small cap value degen. I like my small cap stocks. And in the asset classes, large caps have been dominating. Small caps have
Is
done half.
emerging markets at 2 year to date?
What's that?
emerging markets is second year to date.
Yeah, that surprised me because I've been looking at a rotation out of the U.S. and into international, and this isn't sectors, this is asset classes. But international hasn't done so bad, and emerging markets haven't done so bad either. Now, one of the problems is emerging markets is just if you just take an index, it's heavily China weighted, so you've got to do ex China. I think the Chinese stock market is up 30% in the last month. So that's probably driving most of this. I bet if we checked it a couple of months ago, it would be a different story. So I'd have to see emerging markets ex China. And international is going to be more developed markets. And even then, that's surprising too. But so you're talking about Japan. They've had their the yen carry trade implosion. Japan's not doing fantastic. You've got South Korea. You've got the European Union. You've got Germany, the United Kingdom. There's a lot of places that they were pretty cheap. They've rallied, and the question is what's going to happen next year. The funny thing about large caps is large caps can outperform for a long time. But small caps, they really whipsaw around. And after a bad year, there's more often than not a good year. And I'm ignoring all the bonds and cash because that's too low octane for me. But what do you think the odds are on small caps outperforming in 2025?
I'm hopeful, just as you are. I would love to see some of that, classic mean reversion, just looking at, the past quilt charts and how it's behaved.
Yeah.
And I think, we've talked about this a bit, that the debt wall issue isn't really, all that it seems. And all these companies having access, potentially to, cheaper financing, is only going to be beneficial. And if the market, continues to go risk on, if the AI trade, kind of starts to get moved away from, I think investors are still going to want something with, high potential returns because bonds are just getting, blown to shreds.
Yeah.
I don't think, there's going to be a whole ton of flight to safety there. But I think it also has to do with, who ends up taking the election, right?
Yeah.
If Kamala ends up winning, it's really going to be a sector rotation. I think discretionary and discretionary will definitely benefit. And with Trump, you'll have things like industrials benefit from reshoring.
Yeah.
But either way, unfortunately, I think, all of our small cap energy names, as long as, we're not refilling the strategic petroleum reserve, I don't see an inflection, unfortunately.
Yeah.
And I mean, I'm with you, deep in a bag on small cap, energy names.
Well, I'll just go to the sectors real quick. And energy has the ability to be the worst sector for 3 years in a row or 4 years in a row. So I don't know if energy is going to be a 2025 story, but I have some stocks that like Vermilion Energy, they're doing share buybacks. Whenever the multiple re-rates, the float is going to be less and the earnings are going to be higher. But that might be a 2026 story. But energy aside, small caps, 2025 could be their year. Maybe more likely under Trump than Harris, because I think Trump is a lot more risk on, a lot more going down the quality spectrum. But I'm going to push back a little bit on the bond situation because I think there's a lot of muscle memory in the flight to safety into bonds, and I think that this higher for longer interest rate environment, I think the market participants are going to have to learn that flight to safety into bonds isn't going to work anymore. And one of the problems with that is if enough people do it, then when they buy it, they drive the yield down. So if enough people do it, they cause it to work. So it might take a very long time for market participants to learn.
I mean, how much of this large cap rally has been, a shift of flight to safety to large caps rather than bonds?
Yeah, that the Magnificent Seven is the new safety is just by Apple, right? The new safety is by, well, not NVIDIA, but Microsoft and Apple are the new flight to safety. But I think that's just begun. I don't think everybody's learned that yet, and it might take years before people learn that. So
Yeah, and I mean, I very, different from my value degen nature. But if the market did have an insane pullback, Microsoft is definitely something I would, not turn away from. If you could get that at, at a good, price, I think that, besides for Nvidia, they're going to be prime beneficiary of AI. I like to think about it the same way, the dot-com bubble went down with the internet. Everyone's rushing, and has been rushing into, crowding this market, right?
yeah,
And it's going to turn out having only a few winners. And, Microsoft is consolidating they're buying, not consolidating, but they're buying up a whole bunch of companies in the AI space.
yeah,
And, whoever owns all the assets, especially in an inflationary environment, that's who's going to win.
yeah. I remember taking a look at Facebook when it was $90 a share, in this trough, and it was all about doing all this capex on this what's this the goggles, the artificial intelligence, or the virtual reality glasses, right? Going all in on the metaverse, and the market just hated it. And at the time, I think Dan Ives was on CNBC, and he was saying, look, most of their capex is not even the goggles. Most of their capex is artificial intelligence. They're going to make so much money on ad revenue. And it was a plausible thesis. I did not buy. And yeah, I mean, it was handed to me on a silver platter. The correct
sometimes
thesis.
these large caps move like small caps. Like,
Yeah.
when does a company with a over $1 trillion market cap quadruple?
5x off the lows, and I could have bought there and I didn't, because I mean the correct thesis was really handed to me on a silver platter, and I did not pull the trigger. But I don't know if Microsoft's going to give you the same entry point. It really took the whole narrative had shifted on Meta, and there is the possibility, though. I bet one of the big differences between Trump and Harris is their position on antitrust, because you've got Lena Khan blocking M&A and going after the super cap tech companies. I think this is one of the things where you see Silicon Valley getting behind Trump. They want someone in there that's going to allow mergers and acquisitions and IPOs and get Gary Gensler out of the Securities and Exchange Commission. I think there is going to be a big difference in how the Magnificent Seven behave without somebody like Lena Khan trying to break them all into pieces. But we'll have to see.
I agree with you there.
Let me see. So we've talked about emerging markets. It's kind of maybe, maybe not. Oh, let me show you this tool that I found. It shows countries, their current PE ratio of their stock market, and then compared to the 5-year, 10-year, 20-year average. But it can also give it to you in standard deviations. And you've got the United States 4.5 standard deviations above their 20-year average PE ratio. But you've also got places like Australia, 4.5, Canada, 4.5. And so the argument in the United States, why? Because you could easily say that, Amazon, Microsoft, these companies, the quality of their earnings are so much better now, and the growth rate of their earnings are so high that they deserve a higher PE. But you can't say that about Canada and Australia, because they don't have Google and Microsoft and Apple headquartered there.
So and I'd be interested to see the bottom end of that spectrum of who's trading, below. I think, from a value perspective, that might be, the emerging markets you want to look towards.
Well, that's why I wrote about Ecopetrol, the national oil company of Colombia, because they are at the peak, 2.5 standard deviations below their 20-year average price to earnings ratio. I think a lot of that is because their current president is, he's a former guerrilla fighter, like the most progressive, most left president, but he's been very ineffective at getting his platform through. And in the midterm elections, he lost pretty much all the regional elections. So he's kind of got a year and a half left as a lame duck, and a lot of people are predicting that the country's going to go more centrist in the next election. So I think this is currently dragged down by having a literal guerrilla fighter as their president, and I think that problem's going to fix itself. But yeah, that's why I wrote about Eco Patrol. Um, some of these countries that are below their standard deviations aren't even what I would consider cheap for the risk there. Like the Philippines is the Wild West, and they're still, 2.5 standard deviations below the average, and that's a PE of 10. I don't know um, who was paying a 15 PE to be in an emerging market like the Philippines. I have no idea, but that's not for me. Um, Greece, I think Greece is all shipping stocks, and shipping stocks currently have very high earnings, but that's not, people know that it's temporary because of the Houthis blowing up ships in the Red Sea. And so if Trump gets in there and makes a deal and makes peace, the earnings will fall, but the stock prices might already be pricing that in. But
Yeah, I'm interested in shippers again. If we get a Kamala victory, I think there might be less domestic activity
oh
under
yeah,
Trump, but yeah, I think that could definitely be an area of interest in that sort of outcome.
I'm giving a very hard look right now at Austria, Poland, Japan, and probably special mention is China. So China is at a PE ratio of 9.5, which is below their 20-year average of 11. Plus earnings are low because they're digesting their housing bubble. But the Communist Party of China said that we're stimulating, and the bear case is that the stimulus is small. But once the Chinese Communist Party has said they're going to do something, they do it, and they're very effective at doing it. So I think it's just the beginning. Now, what I'm reluctant about China is you saw what happened with Russia with the sanctions, that anybody who was invested in a Russian company lost all of their investment, and they now have just a placeholder in their account that's valued at zero without any knowledge of when that's going to become a security again, if ever. I don't know if something like that could happen with China. How do you get exposure to China without that risk being there? But I think it really has a strong possibility. And I think the Chinese Communist Party knows they have to get their investing class out of investing in apartments and into investing in the stock market. And there's going to be a real deliberate effort to do that.
Yeah, I've seen you've been writing about Brazil a lot.
Yeah, that's down here at 8.5 PE ratio versus almost the 10. So it's not a full standard deviation below the average. But the situation with Lula is probably similar to Colombia, that Lula was probably going to be too old to run again. And then the question is, are they going to go even, elect a worst communist, or are they going to have a more center candidate? But Brazil is a really strong economy, definitely purchasing power parity metric. It's a very strong economy. But it also overlaps with the whole commodity supercycle thesis, because Brazil is a huge commodity exporter. I'd like some international exposure that's not, because even if it's like a financial company in Brazil, all of Brazil will go up on commodities. So that's why I'm looking at a country more like Poland. I think I'm going to look for something in Poland. But yeah, I like Brazil a lot, because I think one of the beneficiaries for at least the next 10 or 20 years are countries that are big enough to play both sides between the US and China. And India is doing that, right? India is taking Russian oil outside of the sanctions and then selling it back to Europe again and just collecting a fee in between. So any country big enough to play both sides between the US and China, I think, is going to do very well. And I think Brazil is big enough, and it's cheap.
Yeah, it sounds like there definitely is opportunity there.
Yeah. But yeah, this is where I'm going to be looking for. But there's a lot of stock markets that are very high PE ratios, and they don't have the same excuse that the United States does. Like, they don't have Nvidia, they don't have Apple, they don't have Amazon, they don't have Oracle. So why are
Yeah,
they?
I would maybe take a look at some of these Australian and Swiss stocks, see
Yeah,
what potential for maybe a short.
yeah. Shorting is so hard. I mean, I shorted in 2022, but that was because it was a rising interest rate environment, and you can throw a dart at the board and most things are going to go down. I don't know, even at these levels, I don't know what I would want to short into a cutting cycle. But we'll have to see. I mean, it's
Yeah,
one
no, I
possibility.
definitely agree.
Oh, sorry, Mitch. What was that?
No, I was saying I just agree with you that, right now in this market, I would be cautious to enter any sort of short positions. I think, we're coming up on some sort of, uh, major trend change as we start to move away from AI. And nobody can really tell yet what that's going to be. But I feel like we're seeing, some movement towards other sectors, and utilities have been going insane.
Yeah. Well, I my guess is that the utility rally is played out because I think you can only get so much out of utilities. But
Because a lot of the utilities have, big dividends they have to pay out. It's
yeah,
not all growth focus.
yeah, and also the growth is slow. I mean, the utilities are telling the data centers like, okay, we can increase supply 3 years from now. So I don't know that it's going to be the traditional utilities that are going to be the beneficiaries of it, or if there's going to be some more nimble companies that can run in there and build out a power plant for the data center specifically. So I don't know that the utilities are going to benefit as much as people think they're going to benefit. Um, so let me pull up some of
Oh,
these.
speaking of which, we talked about this last time was those three uranium stocks, and I think it's really
Oh yeah,
interesting how they've all moved. So, with Centrus, they have, it's interestingly they, continued to rally while the other two names, had that pullback that I, called out as a potential.
yeah,
So it's interesting they didn't all move together, but this looks like it's, moving up and down in a semi-sustainable sort of way,
yeah,
interestingly enough.
yeah,
So yeah, this was a hell of a call,
yeah.
when you wrote up about it.
Well, this is the only uranium enrichment company, and it's a major bottleneck. They do have a competitor that I have to look into, and this one is getting way more traction on social media. ASP Isotopes. ASP Isotopes. So what they do is they enrich uranium with lasers instead of centrifuges, which I think if that takes off, that could potentially pose a huge threat to the uranium miners. Because the way it works right now is you mine uranium, and 0.5% is that uranium 238, and the rest of it is, I think, uranium 235. But don't criticize me too hard if I get the numbers wrong. So what they have to do is they have to run it through a centrifuge to try and get it up to 5% uranium 238 to use in reactors. I think what ASP Isotopes is doing with lasers is trying to actually, um, you know, and I might be wrong about this, but actually convert some 235 to 238. If that's what they're doing, and I could be totally wrong because I haven't looked into the science about it, but if you don't need, what is it, 10 times as much raw uranium ore to actually make enriched uranium for the reactor, right? If the amount of uranium that needed to be mined was a tenth, suddenly the miners would be in trouble. So I have to look more into ASPI because they're a direct competitor to Centrus Energy, and they might, eventually spell the death of uranium mining. But the Centrus Energy thesis is kind of outside of that because I think even ASPI, their facility that they plan on building is in Iceland. And I guess I'm giving away the stuff behind the paywall, but within our nuclear non-proliferation treaties, it is against the law for the US military to source their uranium from anybody except for a US domiciled US company with US technology and US supply chain. And this hasn't been a problem for 40 years because, and I mean, this should just blow your mind about how energy dense uranium is. All the fuel for our entire Navy, we just stockpiled 60 years worth of fuel and have just been using it for the last 40 years. And uranium is so dense of a fuel source that they could just do that. Could you imagine how much oil or how much coal it would take to stockpile 60 years worth of fuel? It's insane, but uranium is just so dense. So the US Navy knows that they're going to need a US company to enrich their fuel for the naval needs. And also if you do any stuff in space and any advanced stuff with small reactors. So, and those nuclear non-proliferation treaties are probably not going to get undone. And Centrus Energy is the only US domiciled enrichment company that can supply the US military which in about 10 years will be a $1 billion a year market. So this is kind of like the birth of a defense contractor. And so it's like, I mean, if you think the multiples on Raytheon are too high, imagine if you could get in at the ground floor before it was Raytheon, like before they became this massive monopolist for the Department of Energy, the Department of Defense. So, and now ASPI, I think to compete with that, they would have to build in the United States, and right now they're doing it in Iceland. I have to do a write-up on ASPI, and I've got to research it more. But yeah, this was my paywalled Uranium Tourist Part 3 stock, and it's up like 170%. And it still has plenty to go, because you're talking about a monopolist defense contractor, like just at inception. I think it's got at least a 5 or 10x from here, depending on what the size of the market is, and if you compare it with
Speaking of
BWXT.
defense, I think defense could have a potential tailwind with Trump coming in.
I disagree. Have you been following JD Vance and all that stuff?
Not so much.
So JD Vance has a background. Well, he's got a background, I think, from West Virginia and in the Marines, but he's also got a background in venture capital with Peter Thiel. And the Silicon Valley guys, they want to be able to break into the defense contractors. But the defense, it's a good old boys club. Like Raytheon does not want Silicon Valley competing with them. So I think there's going to be this Faustian bargain where JD Vance wants to open up these government contracts to be more open for the bidding process, try and shave like $200 billion out of the defense budget, but of the $600 billion remaining, having a lot more of that able to go to, you know, more tech startups like Anduril and Palantir. So I think the JD Vance is part of his role in the Trump administration. One is to cut the defense budget, but of the defense budget remaining, make it so that Silicon Valley can eat a piece of that pie.
But even if that's the case, that supports the thesis that, you know, some of these public, you know, defense companies that aren't quite, you know, monopolists yet, you know, they could have opportunity.
Yeah, so well, the small nimble ones, right? The more tech startup themed ones, but the stodgy old ones are, I think they're at a real threat, right? They could lose some market share.
Well, that could be a long short.
Yeah, it could be. I mean, it definitely, we'll have to see what happens. And I think that's one of those things that won't get priced in immediately, because it's kind of like Geo Group is, they're that prison real estate investment trust. And it had a huge run up when Trump won the debate against Biden, because people thought, oh, Trump is going to be tough on crime. But a huge chunk of Geo Group's revenue is ankle bracelets for migrant monitoring. But if Trump has a remain in Mexico policy, they're never going to make that revenue. So, I mean, they're going to chop off the leg of this company, even though everybody thinks, oh, Trump is tough on crime, he's going to fill up all these detention centers. No, they're going to be in Mexico. They're never going to have an ankle bracelet on them in the first place. So it's one of those things where the knee-jerk reaction is to think that it's going to be positive with Trump, but the reality might be the opposite. So, I mean, we'll find out, well, maybe not after Tuesday, maybe after a couple weeks, maybe after a couple months. But I think we'll find out who wins the election. And then the trades will kick in. But I think some of those trades that kick in will be wrong, like with Geo Group and with Raytheon. My suspicion, I don't know, this is just kind of kicking it out there to see if I'm right, is in the last election, there were all these lawsuits over the hanky-panky going on at the polls. But at that time, the Republican Party, with Ronna McDaniels at the head of it, they didn't open up the war chest and pursue all these lawsuits. And I think part of the difference this time around is Trump was able to replace the head of the Republican Party from Ronna McDaniels to Lara Trump, which means this time every one of these jurisdictions that kicks out poll watchers, that does, you know, any sort of hanky-panky, is going to immediately be brought to court. I mean, within minutes or hours. And I think that's going to be a very big difference between 2020 and 2024. That's my prediction, is that will sway the outcome. I don't know. What do you take about that, Mitch?
That's interesting. I haven't quite thought about that, but yeah, that definitely seems, you know, like a possibility.
It took a few years, but I think Trump has kind of purged a lot of the never-Trumpers out of the Republican Party, and they've kind of all figured out that you have to get on the Trump bus or you have to be like what's his name? Cheney's daughter, who has now endorsed Kamala Harris. I mean, what an amazing endorsement! Like nobody in the world likes Dick Cheney. He's started 3 wars and shot a guy in the face, and he's going to endorse Kamala Harris. I mean, it's just a bizarre, crazy world. Is it Liz Cheney, his daughter? But yeah, I think the never Trumpers have kind of been excised from the Republican Party, and they've realized that for their survival, they have to get on the Trump train. And that wasn't totally true in 2020 either. So it's a much more united party. And now it's a big tent, right? Now you've got Elon Musk and RFK Jr. Thumping for Trump. I mean, who's thumping for who's thumping for Kamala Harris? It's just, I don't know. The news media makes it seem like it's a coin flip. And in years past, even when when it was a coin flip, they said that Trump was behind 10 points in the polls because of his voter suppression, trying to convince people not to come. Like, oh, your vote doesn't matter. You might as well stay home and not vote. So if before they told you Trump was behind by 10 and he won, and now they tell you it's a coin flip, it might really be a pretty impressive turnout for Trump this time. We'll have to see what happens. There could be lots of hanky-panky with, booting poll watchers out there, but they don't have COVID to excuse it anymore. So we'll have to see what happens. But it's going to be exciting.
Yeah, I feel like last election during COVID time was hard to use as a basis for judgment. This time around is going to be very different. So all the eyes are going to be on it. The market's definitely going to be looking at it. It's just going to be interesting to see how everything reacts this week.
So one of the other main themes that's going on is the whole Ozempic weight loss drug themes. And there's a lot of companies in on it. Some are more popular and trendy.
Yeah, I feel like I've been seeing more and more companies coming out with their own sort of, rip-off version. It's becoming a very saturated market. I think an interesting, chart to look at is Lululemon.
Yeah.
That thing is tanked, large cap. But I mean, the Ozempic was at its highs, and Lulu's getting crushed.
Yeah.
I thought for a while that this was a chart with an opportunity, and it's finally starting to inflect.
That's true.
If we see that theme come back, this might be something interesting. But in the short term, this looks like it's a little bit overbought. Getting to the top of its Bollinger Band and hot on the RSI. I'm not sure this is something I would buy today.
Yeah.
But if we see, a comeback in, the weight loss drugs, I think Lulu is, interesting indirect beneficiary. And
it's consumer discretionary, which has a good chance of outperforming next year. One of the studies that I saw early on Ozempic was the key demographic that was spending money on Ozempic early on were millennial women, like 35-year-old women, because they're single professionals, they have money, they want to look good, they don't have time to go to the gym because they have a career. And the very first thing they did when they lost weight is they would spend upwards of $1,000 on new yoga pants. But Lululemon has new competition. So they have, I think it's called Alo. It's another yoga pant company. So now they have new competition, but they do still have a strong brand. So I don't think they're in as bad a shape as Nike, who they have Hoka and On that are just eating their lunch with women runners. Mm-hmm. But so I think it's probably a good one. But so, I mean, some of the weight loss drug stocks are suffering because there's more competition, but I think the weight loss drug usage in the population is going up. There has been some stuff about side effects becoming more worrisome recently. There's also been some stuff about some competition that has even more effective versions of the drug. So there's a very real possibility you're looking at a United States where everybody is thin because you have a magic diet pill. And then what are the consequences of that?
What is Novo doing? NVO.
So yeah, I know they've been having some.
They're down in the dumps.
Competition is coming for them, right? There's more versions, more competing semaglutide drugs. Some of them are more effective. They can't keep charging $1,000 a month, so that's struggling. In the meanwhile, so Weight Watchers came out with their own version, and they're going to charge $189 a month. On the announcement, it gave them a huge pop, and it came crashing back down. And then, similar to that, I was looking at a company like Medifast, and they have this partnership with LifeMD. And, oh, that's ugly charts. But the thinking process is once you get off the drug, you gain the weight back. If you haven't changed your life, the weight comes back. So we don't know what the long run is going to look like. Is this something like everybody is on Ozempic January and February, and then they, live normally for 10 months and they're back on Ozempic January and February? We don't know what the long run homeostasis is going to look like. But Medifast or Weight Watch should be a company, like, if you have to teach people how to actually keep the weight off afterward, if that's going to be a thing, or if it's just going to be everybody's on Ozempic January and February for the rest of their lives as they yo-yo diet.
Yeah, that's interesting. It's going to be, a trend worth looking into. My guess is there probably will be some sort of seasonality, and I would expect seasonality like right before the summer.
Oh,
right?
yeah.
Everyone wants to have their nice summer body.
Yeah.
So, you might see like a seasonality in like April, May.
Yeah. Everybody starts going on Ozempic in March. They can fit into their swimsuits and go to the beach. And then you also have...
surprise me.
What was that? Go ahead.
No, I was just saying that wouldn't surprise me.
And so my overarching thesis is still the revenge of the old economy. And so I've been promoting gold, oil, and land. Gold has gone crazy. It's that GLD. Is that yeah, so this is it's just been a crazy year for gold. This isn't the commodity price for gold, this is the ETF GLD, but it's been nuts. There's a lot of people saying, it's getting overdone, could be time for a pullback. That's what I said recently as well. It could also not do that, it could also just keep climbing. JP Morgan.
I think, whatever inflation is doing is the best gauge of what gold is going to do. I don't know if you've ever tried to line up the two, charts of like the CPI and gold commodity price, but they follow each other to a T, right? So if you think there's going to be inflation, which we're seeing already that there is, and, the rate cuts are, just spurring it back up, I don't see any reason that, gold will stop, having its correlation with inflation. Well, I think that it definitely could keep rallying if inflation is persistent.
I would have to be a gold enthusiast, I would have to believe that gold is going to outperform inflation. And the reason for that would be the increased uptake for central banks. So JP Morgan put out a report the other day that central bank reserves now are 15% gold. So there's been a massive increase in the percentage of central bank reserves. And if you look back to the 1950s, 1960s, that number, central bank reserves for gold, that could go a lot higher than 15%. And then if stocks and bonds become positively correlated, and bonds don't give you that negative correlation anymore, then when fund managers go to reallocate, they start telling people not to do 60-40. They start telling people to do some energy and some gold. That hasn't even started yet. The retail investor in the United States, the professional fund manager, they haven't even started thinking about putting gold and energy for the negative correlation in their portfolios. So that would be it would take 10 years for it to go through the smart fund managers to the average fund managers to like the Edward Jones fund managers. That's a 10-year process of the typical retirement account having a 1 or 2 or 3% weighting in gold or a 5% weighting in energy, and it hasn't even started yet.
Yeah, I think that could be a huge tailwind if that's going to happen. I think, like you're saying, nobody, not even the smart managers, are doing that yet.
Yeah. Well, and that's what I'm talking about, this knee-jerk reaction that when there's a market crash, you buy bonds. That was because when there was a market crash, the Federal Reserve would cut. And the question is, it looks like they're going to cut in November, but if you have trueflation, ticking back up to like 2.6, if trueflation's getting close to the 3s, And if their own, CPI, PCE measures are sticking strong, how long can this Fed cutting cycle go for? Like how low are they going to bring Fed funds? And then how low is the Treasury going to go if you've got inflation being that sticky? So
Yeah,
it's
I agree. With inflation, it being up, like you're saying, do you think there's possibility we don't see the predicted, 25 basis point cut in November and then again in December?
I think so. If the Fed is going to surprise anybody, they have Nick Timiraos tweet about it. So the Fed has their blackout windows. Nick Timiraos is kind of the go-to person for if Jerome Powell wants to communicate with the market indirectly. He has Nick Timiraos tweet it, and there hasn't been anything from Nick Timiraos about not cutting. So the November meeting is in the bag, probably a quarter point. Otherwise, you'd hear about it on Twitter. Everybody would be retweeting Nick Timiraos saying, hey, now they've changed their mind. But at some point, I think the market's pricing in cuts, a total of 200 basis points, 200 and something basis. So 2 percentage points
they're
of cuts.
pricing in another 50 basis points for 24, a full 100 basis points in 25, and then I believe 50 basis points in 26.
Yeah, I don't think we're going to get 2 full percentage points of cuts from here on out, because that'd be 2.5 total. Because I think before that totally gets fed through the system, I think inflation is going to be rallying because you're going to have, China's stimulus driving up commodity prices. You're going to have the end of destocking driving up logistics prices. You're going to have lowered interest rates potentially, depends what the 10-year Treasury does, but a rebound in consumer discretionary. I don't think inflation's going to let the Fed cut another 200 basis points, but I could be wrong about that. We'll have to see. But yeah, I don't see the cuts being that. So that's going to prevent bonds from being a smart move, because if you don't get those extreme cuts and you don't get the bond prices to go up, you weren't smart to flee into bonds in the first place. So as far as let me go back out to the 5-year. I mean, it looks kind of like, and I was trying to figure out how to annotate on this, but it looks kind of like there's this descending pattern with a lower low and a lower high. But it
looks like there's an annotation box to the left.
Yeah, I was trying to figure out how to write with that, and it's just
maybe the pencil to the right.
Yeah. That was how I got the box, and it's it's I'm not figuring out this website in time, so I'll stop trying to write. But anyway, you can see that it looks like there's some sort of a descending pattern there. But I don't know if that's going to go, all the way to 2026 to when we're in the twos, right? I think that's going to get, this descending pattern I think is going to get cut short some point way before 2026. We'll have to see. I mean, we might think interest rates are still falling into the summer of 2025, but I don't know how much longer. And also, if interest rates go up from here, if we have a higher high, that would be what, 4.6%? I don't know. I don't think we're going to hit it this time, but at some point this pattern I think will break.
Yeah, I agree with you there. It's very atypical behavior, and if it continues to go up, I think that'll just spell trouble.
Yeah. I mean, it's atypical behavior, but not for 1995. And the ongoing question is, are we in 1995 or 1999? And so the Fed cutting interest rates causing the 10-year to rise, that happened in 1995, and it was because there was no recession fear. Right? Everybody's looking around for malinvestment. Everybody's looking around for a banking panic, and there's no evidence of it. So people can unclench and they can sell their recession insurance, which is bonds. So it's not totally without precedent. It just means that probably there's no recession coming. And I think that's the most likely explanation, as opposed to the other explanation is the market is pricing a Fed policy mistake. But I don't think they're going to price that in yet, because the Fed funds rate is still, 4.8? I mean, the Fed funds rate is still not low.
Right.
Well, other themes. So we've talked about central banks buying golds. We've talked about reshoring Um, a lot of these themes, it's going to depend on who wins the election. Because I mean, my prediction is Trump is going to probably win the election, and he's going to go on this blitz because he wants to cement a legacy of him being the great deal maker. I think he's going to go and try and make a new relationship with China. He's going to go out there and try and get the Houthis to stop blowing up boats. He's going to go to Israel and get them to cool things off with Iran. That's going to have some big consequences in the world, especially I don't think he'll be able to reintegrate trade between the European Union and Russia, but he could probably get the Ukraine war settled. But we'll have to see, because I think Trump is going to immediately go on this huge deal-making spree. And the people that he's delegating stuff to, I mean, some of the stuff that his big tent, like RFK Jr. was on TV the other day. He said that, and there was a meta study on this, that fluoride in the water is, it lowers IQ. It destroys brain cells. It's probably responsible for about 5 IQ points from the general population. He says you're going to get fluoride out of the water by January 20th if Trump is elected. I mean, these are huge changes going on. And you've got Elon
That's really
Musk.
interesting. I haven't heard anything about that.
You haven't heard about it? I mean, it's just the stuff RFK is saying is pretty big moves. And then Elon Musk says he's going to, it's almost like Javier Milei with like afuera. He goes, he's going to cut $2 trillion out of the budget, going to fire massive amounts of government employees, give them 2 years severance pay to try and figure out what to do with their lives now that they can't work for government anymore. He tweeted about, hey, is Ron Paul interested in becoming a part of this, cutting $2 trillion from the government? And Ron Paul said, let's talk. I mean, this is extreme stuff happening. So, and who knows, because then there's always the, nothing ever happened sentiment. But I, as jaded and as cynical as I am about nothing ever happening, I think there's actually a chance that there could be some happenings this time. Because, I mean, we're living in some pretty wild times. Attempted assassinations and all sorts of crazy stuff. But there are so many themes that it's hard to know what's going to be working until after we see, one is who's elected. Then you have the lame duck period in 2024. You're still going to have the tax loss harvesting. Which sectors are going to be leading the market in 2025? And which of these themes, and there's a difference between ending the war in Ukraine and reintegrating Russia and the European Union. Like, those are very, very different themes, right? And then cooling things off in the Middle East. Although the energy markets never really priced in the Middle East as if things are going to go really bad there. And then also the drill baby drill, like Trump says he's going to open up all like the Anwar Reserve in Alaska and bring the price of energy down. The price of energy is already cheap. We're in the part of the cycle where the price of energy is cheap. So I don't know how much cheaper he can get it without bankrupting all these American energy companies. So there's all sorts of crazy stuff to happen. And there's, probably not much more we can know until we see how the next few weeks play out.
Yeah, I agree. It's definitely a sit back and watch things unfold type of time.
Yeah. Well, I think we've been talking for about an hour. So let me go ahead and say thank you for coming, Mitch. Are there any sectors or themes that we didn't talk about that we should probably put on our radars that you can think of?
Not that I could think off the top of my head. I feel like we covered a lot. But I am very interested in, the potential of the reshoring theme.
Yeah. And so I've got my Alta equipment group to do that parts and service for forklifts. And I could do better looking for more industrial names. The problem for me with industrials is just that they never really seem all that cheap.
Yeah. Hard to be a value investor in that sector.
Yeah. But all right, let me let you go. Thank you for coming. I really appreciate you giving me the time. And maybe after we see the fallout from the election, the transition team, we can see what the world is going to look like and what themes to buy. But anyway,
that'll probably be a good time to do some more TA.
Yeah. All right. Thank you very much for coming, Mitch. Have a good one.
Yep. Thank you too. Have a good one.